Hello and thank you for clicking on the video. This is the first in a book summary series I am planning to start, where I will highlight some of the key concepts and ideas of core investment books that I think everyone should read or at least know about. I have read all the books shared in this series and hope to share what I've learned through them and provide value and knowledge to you, and hopefully encourage you to read these books or at least explore the concepts I highlight from each of them further. My goal is to provide education on and share some of the most important information to know both before and while investing, coming right from the minds of some of the best investors that have lived. And the first investor we will be learning is the father of value investing himself, Benjamin Graham, and we will be summarizing his famous book, The Intelligent Investor, chapter by chapter here for you. The goal of this book is to provide a framework and mindset to approach researching and analyzing companies through, from which the investor can begin to develop an understanding of the underlying value of the business to make an investment decision on. So let's kick things off with chapter 1, where Graham discusses what he feels differentiates investors from speculators. Two very important concepts to understand before anyone should consider purchasing a stock. It is important to understand early what determines if you are really an investor or simply a speculator in the market. A speculator is simply one who buys a stock on the notion or principle that its price will go up. They do not consider what it means to purchase and understand the company behind the stock. Graham spells this so clearly where he defines investing as an investment operation in one which, upon thorough analysis, promises safety of principal and adequate return. From first glance, it may be hard to determine what Graham means by this definition, as one could buy a stock on the understanding that they believe a safety in their principal, but still be speculating at the core. The key here is the thorough analysis part of the definition, and what is behind these words. To perform thorough analysis, and thus be considered an investor and not a speculator in a company, Graham suggests that one must first analyze the company, not the stock, and the soundness or performance of its underlying business operations before purchasing the stock. Purchase securities in such a way to protect oneself from serious losses, and aspire for adequate, not extraordinary performance out of the security. These three suggestions to be considered an investor may still be challenging to understand when put so plainly, so it's worth expanding into what Graham means by them. When it comes to his first point about analyzing a company's performance, this means that the investor has a framework to consistently study the operating data of a company and establish standards for value and safety of the investment, or in Graham's case, how much are the company's assets actually worth and what are the risks to the investment. As for the second point about protection from serious losses, as an investor, we want to have enough of an understanding of the company such that we believe under normal or likely operating conditions, we are unlikely to experience a total loss of principal. And finally, by adequate, Graham defines this as a rate of return the investor determines themselves to be comfortable in achieving within the levels of risk they are willing to accept. In short, an investor takes time to establish a concept of what the business is worth based on its performance, whereas a speculator gambles and makes decisions based on the price of the stock in the market. An investor will establish a market price for themselves for a share in the company based on their framework of analysis, whereas a speculator will get the price for the stock from the market. An example of speculation and the trap that many can fall into for leading them to become speculators comes with peaks of bull markets or manias like that seen in 1999 and 2000. In the peak of a bull market, it's easy to get caught up in the mania of stock prices going higher and people being willing to pay anything for a company's stock regardless of underlying business performance, on the basis that they can soon sell it to somebody else for a higher price tomorrow. The key here is to recognize when there is a high speed of a stock movement and lack of patience in the market to take the time needed to make proper investments to avoid falling into the trap of speculating. Don't fall into the trap or feeling like you are missing out on making some immediate money in the short term, and remain patient and methodical in your analysis to be able to identify companies that will provide returns consistently over the long term. Because as we saw at the end of the 1999 and 2000 mania, there were a lot of speculators who lost almost all of their principal, never to recover. And this discussion on being an investor versus speculator leads us into Graham's discussion of the types of investors people can be. Graham in general classified investors as one of two categories, the defensive and the aggressive. The defensive investor is one chiefly invested in safety and freedom from bother, an ambiguous definition, but we can dissect what he means here. Put simply, a defensive investor places their funds into high-grade bonds and equities, or businesses that have proven to be of quality. The defensive investor focuses on holding simple ratios of bonds to equities of 50% and 50%, or can shift to 25% bonds and 75% equities, or 75% bonds and 25% equities, depending on the investment time horizon or where favorable market returns may be. This fulfills the idea of safety, as the performance of bonds and equities are usually inversely related, ensuring that the total sum of the investor's capital will be safe from total losses. The freedom from bother comes in the form that the defensive investor does not need to change much to their portfolio other than minor rebalances when the spread between the preferred ratio of bonds and equities begins to diverge, and here Graham recommends a threshold of divergence of about 5%. When discussing the common stock or equities the defensive investor would hold in the portfolio, Graham limits his suggestions to those in the Dow Jones, which can be extended to the S&P 500 that is available to investors today. Conversely, the bonds would be limited to high-grade government bonds or treasuries. According to Graham, this should produce safe and adequate returns that will be lower than the successful aggressive investor, or may even be lower than the market, with the benefit of providing safety on the downside and ease of mind to the investor. So how would the application of the defensive investor look today? The defensive investor would first purchase shares in a well-established fund or ETF of well-established companies to fill out their equity portion of the portfolio. A proxy for this would be to invest in a S&P 500 or a few other broad market index funds. The defensive investor would then purchase, most likely, U.S. government bonds for the bond portion. The final component of the defensive investor to practice ease of mind is to perform the practice of dollar cost averaging their capital into each of these funds and treasuries in a set amount each month, essentially on autopilot, aside from when minor rebalancing needs to be performed. The consistent buying both at market highs and lows should average out in the long term, producing adequate returns for the investor without much thought or emotion being required on their end. The second type of investor Graham describes is the aggressive investor, which is not the aggressive investor in the sense that one might first assume. To Graham, the aggressive investor is one that commits a large amount of time to the in-depth analysis of securities to produce returns greater than that of the defensive or passive investor, while ensuring that their results are not worse than the defensive investor. The aggressive investor is also the more challenging investor to properly practice, as they are more likely to become speculators compared to the defensive investor, which Graham highlights for two reasons. First, the aggressive investor must battle with their emotions and the influences of their emotions in investment decisions. And second, the aggressive investor must endure the competing results of other investors in the market, as the aggressive investor waits for their investment thesis in their holdings to be realized, or in other words, they may underperform in the short term and must endure lackluster performance until they see their investments pay off in the long run. To help combat these two challenges and avoid falling into becoming a speculator, the aggressive investor should focus on analyzing companies that are not popular on Wall Street or in the news, and through their analysis have determined the business operations to be sound. In theory, this should help the investor from being influenced by the media's coverage of the company, the movement of its share price, and allow them to reach their own conclusion on their analysis. The aggressive investor can make use of what Graham calls special situations or investment situations that do not involve the traditional purchase of an equity and holding it long term. These include situations such as company spin-offs, acquisitions, and going short on some securities, for example. However, the caveat here is that investments in these special situations still require the aggressive investor to perform an in-depth analysis of the opportunity, and it is only recommended to those most advanced investors who truly understand how to value companies in each of these situations. In essence, if the defensive investor is a passive approach, then the aggressive investor is the active approach, and because the active investor commits the time needed to perform adequate analysis on a large number of securities to be able to select the more curated investments, they should achieve a higher performance than the defensive investor. However, in order to successfully protect themselves from achieving results worse than the defensive investor, being an aggressive investor requires a much larger knowledge base of how to not only analyze companies, but understand one's own emotions and competencies. Having determined the difference between an investor and a speculator, as well as the two types of investors, it's important to now understand which category you define yourself as before beginning to invest. The first step for any person wishing to invest is to clearly understand what it means to speculate and how to avoid falling into the actions of a speculator. Once you have understood and put limits on yourself to be able to determine when you may be falling into the trap of speculating and how to avoid it, you can then begin to understand what type of investor fits you. For most individuals, the recommendation by Graham is to practice the ways of the defensive investor with either your entire portfolio or a very large majority of it follow the defensive investor's strategy. Graham puts this forward for two main scenarios. First, when you're starting as an investor, you cannot hope to have the knowledge and skills developed to properly practice being an aggressive investor and avoid becoming a speculator. By relegating yourself to being a defensive investor, you are still able to achieve adequate returns while ensuring safety of capital and a disengagement of your emotions as you take the time to develop the knowledge and skills needed for being an aggressive investor. As you begin to develop this knowledge, you can begin to put the skills to practice with a small percentage of your portfolio, such that most of your portfolio is still primarily focused on being a defensive investor. Second, the amount of time needed to be committed to the analysis of companies by an aggressive investor is significantly more with more of the portfolio placed in this style of investing. If the investor cannot keep up with the time commitment, they should not commit a significant portion of their portfolio to following the way of the aggressive investor. The aggressive investor, as Graham described, should only be considered by those who have enough of a knowledge base and time practice to properly perform analysis and dodge the traps of speculation. It is not a beginner approach, and it's up to you to determine how and if you even want to consider practicing being an aggressive investor, as it is actually a commitment. That concludes the summary of Chapter 1 on the intelligent investor, and if you got some value from this video, or it helped you better understand the difference between an investor and a speculator, please hit that thumbs up button below and consider investing in that subscribe button too.